Welcome back to Trading 360. I'm Diane King Hall. Time now for the big three stocks, three charts, three trades. Rick Ucatt will take us through the charts, and here to take us through the trades, we've got Jason Brown, stock market expert at thebrownreport.com and author of 5-Year Millionaire. Jason, it's good to see you today. All right. First of all, before we get into your trades, I want to get a big picture thought on where we are with the market. We're gaining some momentum here. Initially, there was some softness expected kind of coming in today, given the pushback from China on tariff negotiations. What's your overall thought on where we are?
Diane, thanks for having me. My overall thoughts on the market is a lot of the bad news is baked in, and sometimes we swing so far to the bad news side that we forget that anything good could possibly happen. And so we got a 90-day pause on tariffs with some of the other countries. So the only other caveat left is to figure out this whole China piece. And I believe we're closer to figuring it out than we are to not, meaning we've already imposed tariffs of up to, I believe, 145%. I can't see it getting much more higher or much more ridiculous. So now only thing that's left is to see who can take the pain the longest till we both come to the table. So I think upside is the bright side here. I think we go higher versus going lower.
I love that you said how much more ridiculous could it get. All right, so let's talk a little bit about your first trade. You've got Kroger on your shopping list. Now, it hit an all-time high this week. It's been outperforming the S&P 500 this year. Tell us about this one.
So I like Kroger because it's been in an uptrend since 2024. It's in a very predictable, repeatable uptrend and channel. So I like that. I like that it's an inflation and a scarcity play, meaning when prices are up, people still have to buy food. They still have to buy groceries, their consumer staples, and they look for national retail chains like a Kroger who has pricing power and also has their own in-house brands that they can afford to cut prices on and still offer a great deal to people when they're watching their grocery bills creep up. So I like Kroger from that standpoint. However, it's up near resistance. So I want to see it pull back to uptrend and support or the 50-day moving average before we take an option trade on that. And so I'm looking at the March 20th, 2026, so almost a year out, the $65 strike price call option. If we can get that on a pullback, it's going for about $12 right now. I think we could pick it up for about $8 or $9. And then if we can ride that channel back up, we can exit for a pretty decent profit, maybe around $420 a contract based on the delta of the option. And it could produce a 46% return. But first, we got to get the pullback before we can even enter the trade.
Okay, so Rick, tell us then what you're paying attention to the chart, especially Jason just mentioned that resistance level.
So in terms of the channel Jason was discussing, I drew this channel on my own chart here between our two white dashed lines here going across these lows here, and then you could duplicate it and put it across the highs. Matches up pretty decently here. We topped out near 73.63 just recently. That was kind of our high water mark to consider. We can see as well that RSI has been declining during this rally here. Not necessarily a sign of impending collapse or anything, just showing that the pace of the gains is starting to slow down a bit here. Though it keeps traveling up toward the higher end of the spectrum, there is this downward sloping trend line to consider. So look for a potential breakout there above that trend line here. If we were to consider our volume profile and standard deviation channel studies, we can see that for now we are staying above a heavy volume area here. This level near about 66 represents both our volume node and our orange 63-day exponential moving average, as well as some notable lows here during our last trip to the lower end of that channel here. So this could be a supportive area to consider near 65. To the upside, we are right about near our +1 standard deviation channel, so near 72. That's one standard deviation above our linear regression line here, which means our line of best fit. So price is already at a somewhat extreme move now. If we were to keep going higher, 73.63 is those highs. That would be pretty close to Jason's strike price on buying those calls. It would be looking for a push above those highs. If we were to also take a brief glance at a 5-year chart, we can see where, hanging on above those old highs pretty convincingly. 63 was the level that we held firm at after breaking out to the upside here. So, seeming like we're hanging on to some longer term potential gains here.
All right. So seeming like we're hanging on to some longer term potential gains, and that's a long term view that you're taking, Jason. But let's move on to your next trade on your list. You've got ADM on your list. It's down more than 20% over the last year, roughly. What's your plan here for this one?
So I like a variety of trades with long-term options, bullish as well as considering the downside. So when I looked at Archer-Daniels-Midland, try saying that fast 3 times. The stock's been in a downtrend. It just threw a doji at resistance. They have earnings coming up, but if you look at the last 3 earnings, the company missed on earnings and revenue, surprise to the downside. So I don't see much upside above the $49, $50 level. So I'm looking at this as a bear call spread, a short-term yield play, similar to the one that I shared last week with Tesla that worked out pretty nicely. If you sell the May 2nd 50 strike price, you're going to bring in about 35 cents. And then if you buy the May 2nd 52 strike price to cover yourself for about 10 cents, you're going to get a net credit of 25 cents where you're risking $2, but you're really risking $1.75 because you took in that 25 cents credit. So this is a yield play. I think we can get 12.5% in 8 days. But when you take in the fact that we took in that 25-cent credit, it's more like a 14% yield play in 8 days. And then you got 2 days where the market is closed because it's the weekend. I don't see the stock moving above the $49 level before earnings. And if history repeats itself, they most likely won't meet or beat earnings as well.
I had a feeling it was going to be a bearish take, well, neutral to bearish take here on this one. So, Rick, talk to us about the patterns you see on the chart for ADM.
Sure, to help visualize some of what we're talking about here, you can see the downward channel quite consistently here for much of the past trading year. Our 2 white lines, just same thing again, connecting the high points in a downtrend, duplicating the line, putting it across the lows, happens to match up pretty well. You'd be surprised how often that shows up like this here. Nevertheless, 50 to 52, that's this range right around here, kind of the range of the short call area, short call spread area. So right around that point is where this trade would be looking for price to kind of stay below. But now we can see that we are crossing up to that resistance level here. We've got not only our old highs near about 48.50, but also our trend line roughly in confluence there. We are above our moving averages that we follow, our yellow 21-day and orange 63-day exponential moving averages. Price has closed above them. They're starting to trend upward instead of downward, so that's an early sign of potential trend change. RSI also has broken above the 50 midline, signifying a shift to more bullish momentum here. If we were to look at our other studies as well, we can see that we had heavy volume here near these lows, so that could be a sign of a potential bottom. That's typically how that is interpreted when there's heavy trading near a low point. But then we have another node here in that same region we were just talking about, 51 to 52. So that could be another resistance area to consider based on that factor here. But we can also see we are at the lower end of the range here near our 5-year lows. A long-term downward sloping trend line could be on the verge of being broken.
Okay, all right. Jason, let us go to your final trade on your list. You've got Chevron on your list. It's been all over the place recently. It hit a 52-week high and low in just the past month. So what's your view and approach here?
What I love about Chevron here is this one's for my people who want to trade options, but also may want to own the stock. And so it's been in a channel since March of 2022, channeling between 135 and the 170 range. And so right now we're back down near support near that 135 range. So I'm looking at this as an opportunity to do a covered put, meaning you sell a put, you get paid to try to buy the stock. So if you look at the May 30th 135 strike price put, it's going for $5. So you can bring in $5 or $500 per contract. And as long as the stock stays above 135, you're talking about a 3.7% yield in 36 days. But what I like about this is it hasn't really broken below that support level, like I said, since 2022. So if you get put the stock, you get a $5 cushion. And then this is a stock that pays a dividend. They pay about $6.84 a year, which means you get $1.71 a quarter. So you also get paid to get into the trade if you get the stock put to you from the option. Then you also get paid for holding the stock while we wait to see if it channels back up near the top. So I really like this trade for a safe, company to own, a safe get paid to try to buy it at a discount, and a safe dividend to get paid for waiting.
Okay, so this seems like a safety is the goal here. But Rick, then tell us what you see when it comes to the chart for Chevron.
So this one, we saw a very severe drop-off on a lot of this tariff-related news flow here. You can see we were at the highs near 169 or so, and how quickly things changed. A very precipitous downfall to this old support level, though, 135.37. If you backtrack over here, matches up with this low point. Now, the trend line was pretty convincingly broken at this point, and we do have an upside resistance area to consider. This repeated double bottom low here matches up with the post gap down plunge highs. So around 147.50 gives us a convenient place to keep an eye on based on old support becoming new resistance. We can see that RSI has managed to show a little bit of bullish divergence here, meaning that price made a higher or RSI made a higher close even as price made a lower close. So that's a sign that there could be bullish momentum accumulating in this name here. So we can see now to include our other studies here. Well, there's a slight volume node here lining up with our -1 standard deviation channel, as well as our 21-day EMA. So around 144 could be a breakout point on the way to 147.50. To the downside, our recent lows match up with the -2 channel. 135 seems like an important area to hold. If we were to also take a glance at our longer term chart here, we can see that we are near a long-term supportive area. 132 matches up with these low points that we saw here during some of these more severe declines here. But for now, kind of hanging on in an uncertain situation, it seems like.
Okay, uncertain situation right now, but things can certainly change. All right, Rick, thanks a ton for taking us through the chart for Chevron and beyond. That's Rick Ucatt, lead market technician here on Schwab Network, and Jason Brown of the Brown Report and author of 5-Year Millionaire. Thank you both for being here.